The end of the year is one of the most important times, and not only for investors, but for everyone who has money, because there are so many decisions to make that impact our overall finances. And this time around, the year's end is marked with a lot of financial challenges, including inflation, market volatility, domestic and political uncertainties, and global geopolitical risks. So to help you navigate these complicated times, in this video, I'll cover 12 year-end checklist items to review and implement as applicable. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one year-end item you want to check is that you're maxing out your 401k. By maxing out your 401k, not only are you ensuring that you're receiving your employer match, but you're also lowering your taxable income. In my book, maxing out your employer retirement account is one of the simplest yet the most effective ways to reduce your taxes. Workers who are younger than the age of 50 can contribute up to $20,500 to a 401k in 2022. And if you're at least the age of 50, you can add an extra $6,500 per year in catch-up contribution. Most often, the easiest way to do this is to set up automatic withdrawals at the beginning of the year to max amount so you don't need to think about making any adjustments at the end of the year. This helps psychologically because you get used to seeing the less take-home pay every paycheck, and it also helps you save time because you aren't scrambling at the end of the year calculating how much more money you need to contribute. Some hardcore people I've seen even front-load all their 401k contribution at the start of the year, setting 100% of their paycheck to a 401k contribution until they hit the max. The bottom line is that you want to make sure that you're taking full advantage of your 401k by December 31st. The number two year-end item follows a similar theme to the first as in regards to maxing out your retirement account, and that is to max out your Roth IRA contribution. In my personal opinion, the Roth IRA is one of the most tax-efficient and effective accounts available to investors. Contributions are made on an after-tax basis, but any growth and withdrawal is tax-free. We just don't know what the tax landscape will look like in the future. New politicians are constantly entering the political landscape, and we have no idea what new initiatives could impact our taxes. When you contribute to a Roth IRA, you mitigate the unknown tax-related risk in the future because you've already paid taxes on your money. For 2022, the maximum Roth IRA is up to $6,000, $7,000 if you're 50 or older. For Roth IRA, you usually have until a tax filing deadline, typically April of the next year, to contribute. But my thought is, why wait? Max it out as soon as possible so you don't have to think about it. The easiest way to ensure you're maxing out your Roth IRA every year is to set up automatic contribution at the start of the year for the maximum amount. For example, $6,000 divided by 12 months, have $500 deducted each month from your checking account and have it automatically invested. The number three year-end item isn't for everyone, but if you're eligible, make sure to max out your HSA. If your health insurance is part of a high-deductible health plan, also known as HDHP, you can open up a health savings account, the HSA. HSA offers what's known as triple tax benefit. Your contributions are tax-deductible, your money grows tax-deferred while in the HSA, and you can withdraw money from your HSA tax-free as long as it's used to pay for qualified medical expenses. The limits of pre-tax funds contributed to an HSA for 2022 are $3,650 for a single person, $7,300 for a family, plus an additional $1,000 if you're 55 or older. If you've never heard of HSA before, no worries. If your company offers a high-deductible health plan and you're relatively healthy, consider choosing an HDHP during your next enrollment period so you can open up a HSA. As I mentioned earlier, this will allow you to take advantage of the triple tax benefits. An unspoken secret to HSA is that not all expenses necessarily need to be used for healthcare expenses. If you want to learn more, check out my video here where I go more in depth. The number four year-end item is a good consideration if you're still looking to lower your taxable income, and that is to give. According to the IRA, you may deduct charitable contributions of money or property made to qualified organizations if you itemize your deductions. Qualified organizations like your local church or your favorite nonprofits. If you're already giving, make sure to get a receipt for your donation so you have proof. I've seen too many people who are already making sizable donations not understand how it impacts their taxes. If you're struggling to find a specific organization you want to give your money to, not a problem. A way I've gotten around this dilemma has been to open up a donor-advised fund. A DAF is an account where you can deposit assets for donation to charity at a later point in time. A great thing about a DAF is that you get an immediate tax deduction the year you contribute to the DAF. If you'd like to learn more, make sure to check out my video here where I go more in depth. The number five year-end item also might not be for everyone, but if you have kids, you might want to check your contribution amount to your 529 education savings plan. A 529 education savings plan is basically like a Roth IRA, but for education expenses. Contributions are made on an after-tax basis, but growth is not subject to federal taxes. Some states offer state-level tax deductions on 529 as well. 529 plans do not have an annual contribution limits, but contributions are considered completed gifts for federal tax purposes, which falls under the annual gift tax exclusion. In 2022, you can give up to $16,000 per year, gift tax-free per person. The annual exclusion recycles on January 1st, so if you don't use your 22 gift allowance by then, you lose it. Make sure to consider this as you calculate how much to contribute to your kids' 5 to 9 plan. Just a quick personal perspective on this. I do have a 5 to 9 plan for my kids, but I only contribute a moderate amount. I personally believe that education is one of those things that if you're creative, there are tons of different more cost-effective ways to fund it. My wife's nursing education is a great example. When she was an undergrad, she was able to find a hospital willing to pay for her bachelor's if she committed to working there after she completed her degree. And with her nurse practitioner degree, her employer was also willing to pay 100% for the degree if she was willing to continue working and commit another 3 years afterwards. Now, was this easy? Of course not, and I'm so proud of her achievement. I believe that in the long run, passing on to our kids the example of hard work and sacrifice is actually way more important than a fully funded 5 to 9 account. Alright, enough of my soapbox talk, let's move on to the next year-end checklist item. The number 6 year-end item is to make sure that you're spending down your FSA, the flexible spending account. I like to think of the FSA like the shorter, less attractive cousin to the HSA. Like the HSA, you can set aside pre-tax money from your paycheck for medical and dental care expenses that insurance doesn't cover. However, there is a deadline unlike the HSA, often at the end of the calendar year by which you need to spend the funds or lose them. And making sure to check your FSA account is very important right now because in the last couple of years, the federal government let employers relax those rules through the pandemic to give people more time to spend the money. But now the rules are coming back to normal and many individuals may have more cash than usual to spend in the coming months. There is no easy way to get around this except to purchase items that you could really use, ideally for the long run. FSA contributions can pay for a broad range of products including over-the-counter medication, first aid kits, and other health-related items. Amazon makes it easy by identifying products that are FSA and HSA eligible. I had this happen to me a couple times, and let's just say that the Kim family will never need to buy Band-Aids again as long as we live. The number 7 year-end item on our checklist is to consider tax loss harvesting. The basic idea behind tax loss harvesting is that you sell your investments that have decreased in value and then use the losses to decrease your income taxes. This might be especially useful in a year like this when we've seen the market dip by up to 20% from the start of the year. Let's say that you bought 100 shares of Vanguard Total Stock Market Index Fund for $100 last year, and now it's worth $90. Your $10,000 investment is now worth $9,000, and you have $1,000 worth of unrealized losses in your portfolio. If you sell your shares of VTSAX and take the $1,000 loss, you can then use that loss to cancel out any capital gains or lower your taxable income by a maximum of $3,000 per year. Better yet, any losses in excess of $3,000 can be carried forward for future years. And as long as you understand the wash sale rule, which is when you sell shares at a loss but buy substantially identical investments 30 days before or after the sale, and you can work around this, you can have your cake and eat it too. You get to not only reduce your taxes, but get right back into investing those same dollars. After you sell your shares of VTSAX, purchase shares of fund that performs similar but tracks a different index, like the Vanguard 500 Index Fund, also known as VFIAX, a fund that tracks the S&P 500 instead of the total market. Smart investors don't just let the market take them for a ride, but they take full advantage of it by implementing strategies like the tax loss harvesting. The number 8 year-end item on our checklist is to review our asset allocation. The market went down significantly in 2022, so there is a good chance that your asset allocation is a bit out of your target allocation. It could make sense to rebalance your portfolio over the next couple months to ensure that your allocation is brought back to its appropriate risk tolerance. However, I do want to caution that we don't want to get too carried away with this. If our allocation is off by a couple percentage points, my personal take is that it's not worth adjusting at this time. The market is fluid and there's a good chance it may correct itself naturally. Check it out to make sure you're in the right ballpark, but don't obsess over it. Another note I'd like to mention here is that this is where the benefit of a simple asset allocation comes into play. I know people who love to slice and dice their portfolio into 8 different asset categories and classes. Some in small caps, some in mid caps, some in emerging markets, some in commodities. I understand why people do this because it could lead to higher returns. But when it comes to rebalancing, do you see how this could become a nightmare? Trying to adjust 8 different buckets instead of just 2? I firmly believe that most people would do well with a simple 3-fund or a 2-fund portfolio. Simple is good and simple is effective because it keeps us on track despite what the market is doing. But regardless of whether you agree with me or not, review your asset allocation before the year end. The number 9 year-end item on our checklist is to review our estate plan. And this is especially important if we have family members that depend on us. Although your estate plan is not an investment, it determines what happens to your investment and assets once you die. Ask yourself the following questions. Are all your assets included in your estate plan? Did you acquire any new ones this year that needs to get added? How about beneficiaries? Retirement accounts and insurance policies have beneficiary designations, so make sure to review your various beneficiary designations to ensure that your money is passing according to your wishes. Also, if you set up a trust, make sure the beneficiary listed there are updated as well. I've seen people who had a new kid and hadn't updated their estate plan yet, and that was 6 years ago. Make sure not to leave little Johnny out of your will. If there are any changes, consider reaching out to your estate planning attorney to review and update your planning documents such as your will, power of attorney, healthcare proxy, and many more. The number 10 year-end item on our checklist is to review our insurance coverage. Life gets busy and it's easy to fall into set it and forget it mentality, especially with our insurance coverage. I mean, how many of us can honestly say we remember the last time we read our home insurance policy document? But with time, our assets may have grown to include multiple homes or other assets. We want to ensure that everything we own is adequately covered. I believe that the 4 must-have insurances that we can't live without are the following: homeowner insurance, auto insurance, health insurance, and term life insurance. Review your coverage, even just briefly, to ensure that your family and your assets are properly protected and your policies are in line with what you expected. You might even find some savings. I used to have my auto and home insurance with different companies, and when I realized I could save money by bundling them under one company, it was a no-brainer move. The number 11 year-end item on our checklist is more forward-looking, and that is to understand the 2023 tax changes. Tax credits, tax deductions, and income tax brackets are constantly changing. You want to be mindful of them so you can set yourself up for success to kick off the new year. For example, for 2023, the contribution limit for 401k is increasing to $22,500, and for Roth IRA, $6,500. If you want to continue to maximize your contributions, you want to tweak your plan now to take full advantage at the start of the new year. Increasing the monthly withdrawals from your paycheck and your checking account to start January 1st, so you aren't needing to make any adjustments at the end of next year. The 2023 federal income tax brackets are also updated compared to 2022. Though there might not be specific action steps to take with these changes, it's good to know. For example, are you planning to move to a higher paying job next year? You want to understand if this move will push you up to a higher tax bracket that might make you reconsider. Likely not, but something to think about. The number 12 year-end item on our checklist is my favorite, and that is to look at your financial goals for 2023 and update your budget. I'm obsessed with goal setting and planning. I'm so obsessed that I have a whiteboard in my bedroom where I technically encourage my wife to join me in our planning session. As we come to the end of the year, it's good to reflect on how we did this past year, and we can start visioning and thinking about the future, and use your budget as a tool to help you reach those goals. I like to look at our budget line by line and see if there are any areas we can cut back, or areas that we were unrealistic with, so we need to increase. It's good to do this regularly, maybe once a month, and not wait until the end of the year, but if you haven't yet, maybe now is better than never. Thank you guys for watching, and hope this year-end checklist helps you to create a framework for approaching the end of the year. If you'd like to learn more about other ways to optimize your life, check out my video here where I review the 5 life's greatest investments. And they're not stock market related. Until next time, all the best.